Hey everyone, welcome back. So today's explainer is absolutely crucial. We're diving into what is quite literally a blueprint to wealth. Okay, imagine for a second you're building your absolute dream house. You wouldn't start by picking out fancy light fixtures or, I don't know, beautiful granite countertops, right? Not if your foundation is cracked and the roof is caving in. That makes zero sense. But you know what? When it comes to personal finance, that is exactly what most people do. They just skip all the foundational work and go straight to the exciting stuff. Well, today we are going to fix that. We're breaking down the exact, mathematically optimal sequence to invest your money, step by step. To really grasp why this matters so much, let me share a phrase that perfectly captures a massive frustration for financial experts. Quote, watching people throw money at the stock market, completely ignoring credit card debt. End quote. I mean, it's so tempting, isn't it? Treating the stock market like a slot machine, just hoping for that quick win, all while carrying toxic 22% credit card debt right in your pocket. Doing that is literally like trying to fill a bucket that has massive holes in the bottom and then standing there scratching your head, wondering why you aren't making any progress. And the reality of where most folks are starting today is honestly pretty shocking. Data shows that 1 in 3 Americans doesn't even have an emergency fund at all, and the median amount saved for emergencies is just $500. Actually, scratch that, it's down to $500 from $600 last year. To put that into perspective, that is less than most people's monthly car payment. Meanwhile, these same folks are out there asking if they should buy individual stocks or cryptocurrency. It's kind of like asking if you should buy a Ferrari when you don't even have the cash to fix the transmission on your daily driver.
So let's dive right into this. Here is our roadmap for today. Number 1, the costly investing mistake. 2, securing your foundation. 3, employer match cheat code. 4, the tax optimization zone. And 5, final investment frontiers. This is the exact step-by-step sequence you need to follow to maximize your returns and eliminate financial risk.
All right, Section 1, the costly investing mistake. It is officially time to stop the bleeding.
And this brilliantly illustrates exactly what I mean. The opportunity cost of getting distracted by shiny new investments while you're just bleeding money to high-interest debt, it's massive. Every single month you delay paying off high-interest debt to go chase stock market gains is a month that your debt grows faster than almost any investment you could reasonably expect. Mathematically speaking, carrying credit card debt while investing is like trying to run a marathon with a backpack full of rocks. Paying off credit card debt that charges 22% interest yields a guaranteed 22% return. Think about that. That guaranteed return is way higher than average stock market gains after taxes, which are, entirely variable. Every dollar you put toward that debt earns a guaranteed 22%. That outpaces even Warren Buffett's long-term average. No joke.
So, to avoid that trap, we have to follow a really specific sequence. Step 1, emergency fund. Step 2, high-interest debt. Step 3, tax-advantaged accounts. And Step 4, taxable accounts. Notice how each step meticulously builds on the previous one? If you skip around, your financial house is basically going to sink right into the quicksand.
Moving right along, Section 2, securing your foundation. Let's build that bedrock.
Now, what's really interesting about this is that the absolute bedrock of your financial house has to be an emergency fund. Now, I know, it sounds boring. You'd probably much rather hear about the next big tech stock. But an emergency fund creates a crucial psychological safety net. It literally stops you from making terrible financial decisions when life inevitably throws you a curveball. The goal is to start by saving your first $1,000 as quickly as possible to cover those minor, annoying emergencies. Then build toward 3 to 6 months of expenses, depending on how stable your job is. Vanguard actually did some research on this, and they found that people with at least $2,000 in emergency savings had financial well-being scores that were 21% higher than folks without one. 21%! That was the largest boost linked to any single financial factor they measured. So $2,000 might not sound like life-changing money, but the psychological impact of having that buffer, it is absolutely enormous.
Once you've got that foundational safety net in place, you need to ruthlessly target high-interest debt. We're talking anything over 8% annually. And the mathematically superior way to do this? The debt avalanche. This is where you pay minimums on all your debts and then throw every single extra dollar you can find at the balance with the highest interest rate. Now, I know the debt snowball method, where you pay the smallest balances first, can feel really good psychologically. But the avalanche method, it is so much more efficient. For example, say you have $5,000 in credit card debt at 22%. If you only pay the minimums, you're going to pay nearly $2,800 just in interest over 5 years. Just in interest. The avalanche method stops that bleeding fast.
But wait, there is one major exception to the debt first rule. Section 3,
the employer match cheat code.
This is a crucial pivot point, and it actually has to come before you finish paying off your high-interest debt. If your employer offers matching contributions to your retirement plan, you absolutely need to grab it. The math here is staggering. Let's say you make a $50,000 salary and your employer matches 50 cents on the dollar up to 6%. Contributing $3,000 of your own money gets you a $1,500 match. That is a 50% immediate, guaranteed return. Even if you're carrying credit card debt at 22%, getting a 50% or sometimes even a 100% immediate return on an employer match makes absolute mathematical sense. It is literally free money just lying on the ground. The only catch here is you've got to understand your company's vesting schedule. Basically, how long you need to stay at the company to actually keep those matching funds.
Okay, let's move to Section 4 and see how this builds, the tax optimization zone. Time to shelter that money.
So your emergency fund is set, your bad debt is gone, and you are getting your full employer match. Now we start framing the house. We want to shelter our money from the IRS using specific tax-advantaged accounts before we just dump more cash into a 401k. The very first step here is your IRA, your individual retirement account. Now, you might be wondering why an IRA before maxing out the rest of the 401k? Well, it's because IRAs have significantly lower fees. We're talking just a few basis points compared to the 1% to 2% fees that are pretty common in 401ks. And those higher fees, they will eat your returns like termites. So once you open an IRA, you face a huge choice, Roth versus traditional. Roth means you pay taxes right now, but your withdrawals in retirement are totally tax-free. Traditional means you get a tax deduction now, but you pay the taxes later. The general rule of thumb? Young earners in lower tax brackets should probably lean Roth. High earners at peak income should lean traditional to lower their current tax burden.
Next up in the tax optimization zone is something I consider an absolute financial superpower. If you're eligible through a high-deductible health plan, the Health Savings Account, or HSA, is the ultimate Swiss Army knife of investing. It offers triple tax benefits. Seriously, 3 of them. You get a tax deduction on the way in, the money grows tax-free, and withdrawals from medical expenses are completely tax-free. It is the only account in America that gives you tax benefits at all 3 stages. You can literally pay out-of-pocket for medical bills today, save your receipt, and reimburse yourself totally tax-free decades down the road.
The math on this is going to blow your mind. Maxing out an HSA for 30 years at a 7% return can yield over $400,000 in completely tax-free money, specifically for medical expenses. To put that into perspective, the average retiring couple faces about $300,000 in healthcare costs. An HSA can virtually eliminate that massive expense from your entire retirement budget. So only after you max out your HSA, that is when you go back and max out your 401k, up to the $23,500 limit for 2025.
So, the crucial point is we finally put the roof on our house. Section 5. Final Investment Frontiers. Taxable Accounts. Between your IRA, your HSA, and your 401k, you could potentially shelter over $35,000 annually from current taxation. Only after you have completely maximized those previous shelters do we graduate to the taxable investment account. This is the Wild West. There are no contribution limits, no withdrawal restrictions. You want to buy individual stocks, options, whatever, go for it. But look at this opportunity cost. If you invest $10,000 annually for 30 years at a 7% return in a tax-advantaged account, you end up with about $944,000. Do the exact same thing in a taxable account where the IRS takes a cut of every single dividend and capital gain along the way, you end up with closer to $700,000. That tax drag is a nearly $250,000 opportunity cost. It is literally like running a race while someone keeps throwing sand into your shoes.
Now, to be clear, taxable accounts aren't bad. Not at all. They're just the final step. Once your financial foundation is perfectly ordered, taxable accounts offer incredible strategic benefits. They give you complete flexibility for big goals like a down payment on a house. They also offer vital bridge funding if you want to retire early, before you're legally allowed to touch your 401k without a penalty. And if you plan to leave money to your kids, taxable accounts actually get a step up in basis when you pass away. That can entirely eliminate capital gains taxes for your heirs. It's a huge deal.
By following this specific order, emergency fund, high-interest debt, employer match, IRA, HSA, maxing the 401k, and finally taxable accounts, you are securely building wealth while everyone else is out there just rolling the dice. So I want to leave you with this provocative question to think about today. Is your financial foundation actually ready for the Wild West? I highly encourage you to audit your own financial backpack, Fix the cracks in your foundation, plug those massive holes in your bucket, and get your house perfectly in order before you go chasing the next shiny stock. Your future self will absolutely thank you. Keep learning, keep optimizing, and I'll see you on the next explainer.